Rule of 72 versus Rule of 70, the ultimate investor showdown. Intro investing can feel ridiculously complex, right? It's a world of dense spreadsheets and algorithms so complicated you'd think you need a PhD to understand them. But what if one of the most powerful ways to track your money's growth was just a simple piece of mental math, a trick that dates all the way back to the 15th century? A secret weapon that tells you, in seconds, how long it'll take for your investments to double. Most of you know what I'm talking about. It's the reigning, undisputed champion of financial shortcuts, the Rule of 72. It's simple, it's effective, and it's usually the first trick investors learn to quickly size up their portfolio. But what if there's a challenger? A lesser-known contender that some experts argue is faster, leaner, and, in some cases, way more accurate. Today, we're stepping into the ring for the ultimate investor showdown. In one corner, the celebrated legend, the Rule of 72. And in the other, the agile challenger, the Rule of 70. By the end of this, you'll not only master both of these powerful tools but also know exactly which one to use to make smarter, faster decisions about your money. Act 1, Mastering the Champion, the Rule of 72. First up, the heavyweight champ, the one we all know and love, the Rule of 72. And its fame is well deserved. For centuries, investors have used this elegant shortcut to get a quick feel for how long it takes an investment to double. The formula couldn't be simpler. You just take the number 72 and divide it by your expected annual interest rate. That's it. The result is the approximate number of years it'll take for your money to double. So, the formula is, years to double equals 72, interest rate. Just remember, you use the interest rate as a whole number. If your return is 8%, you divide 72 by 8, not 0.08. Let's make it real. Imagine you've got $10,000 in an investment portfolio, and you're hoping for an 8% average annual return, which is pretty close to the stock market's historical average. Using the rule, you take 72, divide it by 8, and you get 9. That means it'll take about 9 years for your $10,000 to turn into $20,000. And thanks to the magic of compounding, in another 9 years, it doubles again to $40,000, and then to $80,000. The rule works because it's a handy simplification of a much more complex logarithmic formula for compound interest. It's built on the idea that you're reinvesting your earnings, letting your interest earn its own interest. This is the engine of wealth creation, and the Rule of 72 is like the speedometer. But no champion is perfect, and you need to know the Rule of 72's weaknesses. First, it's an approximation. It's a quick estimate, not a pinpoint accurate calculation. It works best for interest rates between 6% and 10%, with 8% being its sweet spot. Go too high or too low, and the estimate gets a little fuzzy. Second, the rule assumes a steady, fixed rate of return, which, let's be honest, rarely happens in the real world. Markets go up and down. And finally, the simple formula doesn't factor in things like taxes, fees, or inflation, which all take a bite out of your returns. For instance, if your investment earns 8% but you're paying a 2% management fee, your real return is only 6%. Suddenly, your doubling time jumps from 9 years to 12 years, 72 divided by 6. That's 3 extra years lost, just to fees. The Rule of 72 is also great for understanding the dark side of compounding, debt and inflation. If you have credit card debt at a 24% interest rate, the rule tells you the amount you owe could double in just 3 years. If inflation is running at 4%, the purchasing power of your cash gets cut in half in about 18 years. So, the Rule of 72 is versatile, powerful, and a true legend of finance. But is it the best tool for every single job? To answer that, we need to meet the challenger. Act 2, the challenger, the Rule of 70. Now, let's turn to the challenger, the Rule of 70. While the Rule of 72 is the star of personal finance, the Rule of 70 is a favorite in academic circles, often used by economists to estimate things like GDP growth or population doubling. But for investors who crave precision, it has a very important role. The formula is, you guessed it, just as simple: years to double equals 70, growth rate. At first, it seems almost identical. But that tiny 2-point difference creates some fascinating results. The Rule of 70's real strength is in specific scenarios. It's generally more accurate for lower interest rates, especially those under 10%. It's also the go-to rule when dealing with continuous compounding. So what does that even mean? Most interest we see is compounded on a schedule, daily, monthly, or yearly. Continuous compounding is a theoretical idea where interest is calculated and added at every possible instant. You won't find this with your savings account, but it's used in advanced financial models. The nerdy origin of this rule is actually the rule of 69.3, which comes from the natural logarithm of 2. But since 69.3 is a pain to calculate in your head, it gets rounded up to 70 for simplicity. So how does this challenger actually stack up? Let's use our $10,000 investment with an 8% annual return again. With the rule of 72, we got 9 years. With the rule of 70, we get 70 divided by 8, which is 8.75 years. The true mathematical answer is 9.006 years. So in this case, the rule of 72 was practically dead on. But let's try a lower rate, like 5%. Rule of 72, 5 equals 14.4 years. Rule of 70, 5 equals 14 years. The actual answer is 14.2 years. Here, the rule of 70 gets a little closer. Okay, let's try a higher rate, 12%. Rule of 72, 12 equals 6 years. Rule of 70, 12 equals 5.83 years. The actual answer is 6.12 years. And the rule of 72 wins again. This brings us to the main event. It's time for the final showdown, where we put these rules side by side. Act 3, the ultimate showdown and amp, the verdict. Alright, let's break down the tale of the tape. In this corner, the crowd favorite, the rule of 72. In the other, the precise specialist, the rule of 70. We'll judge them on two things, ease of use and accuracy. Round 1, ease of use. This is a knockout victory for the rule of 72. Why? Because the number 72 is beautifully divisible. You can slice it cleanly by 2, 3, 4, 6, 8, 9, and 12. This makes mental math a breeze for the most common interest rates. Thinking about a 6% return? 12 years. A 9% return? 8 years. A 12% return? 6 years. The math just flows. The number 70, on the other hand, only divides cleanly by 2, 5, 7, and 10. It's not hard, but it just isn't as slick for those quick, back-of-the-napkin calculations. For sheer practicality, the rule of 72 is the undisputed champ. Round 2, accuracy. This is where things get interesting. It's not about which rule is always right, but which one is right for the job at hand. As we saw, the rule of 72 is king around an 8% interest rate. It's incredibly reliable for the typical investment return range of 6% to 10%. The rule of 70, being a simplified version of the rule of 69.3, is technically built for continuous compounding. For the annual compounding most of us use, it tends to be more accurate at lower rates. At a 3% interest rate, the rule of 70 says 23.3 years, while the rule of 72 says 24 years. The true answer is about 23.45 years, making the rule of 70 the clear winner there. So who wins on accuracy? It's a split decision. For most stock market investors thinking in annual returns between 6% and 10%, the rule of 72 gives you an answer that's more than good enough. For economists, or for investors with very low yield assets, the rule of 70 has a slight edge in precision. The final verdict. So, after all that, which rule should you actually use? Here it is. The rule of 72 is the everyday champion for most investors. Its incredible ease of use and solid accuracy in the most common investment scenarios make it the best tool for quick, practical financial planning. It helps you instantly compare options, see the damage fees can do, and visualize your long-term growth. The rule of 70 is the specialist. It's the precision tool you pull out when accuracy at lower rates really matters, or when you're thinking about continuous growth concepts like inflation. The real winner isn't one rule or the other. The winner is you, the informed investor who knows you have both. Knowing when to use the quick and dirty champion and when to call on the precise specialist is what separates a good investor from a great one. The bigger picture, why this fight even matters. Look, the debate between 72 and 70 is fun, but it's not the most important part. What's truly important is the powerful principle they both demonstrate, the magic of compound interest. These rules aren't just party tricks for finance nerds, they are your gateway to understanding how wealth is actually built. Whether it takes 8.75 years or 9 years for your money to double is just a detail. The revolutionary idea is that your money can double, and then double again, on its own. All it needs is time and a consistent return. That's how a small seed of savings grows into a mighty financial tree. These rules make time and growth tangible. They empower you to set real goals. If you want to double your money in 10 years, you now know you need to aim for a return of about 7.2%, 72 divided by 10. Suddenly, a vague hope becomes an actionable target. It forces you to think about risk, fees, and strategy in a very concrete way. So, we've seen the champion, the Rule of 72, defend its title as the go-to tool for fast financial estimates. We've also seen the challenger, the Rule of 70, prove its worth as a specialist. The main thing is that you now have both of these tools ready to go. Use the Rule of 72 to quickly size up an investment or see the crushing cost of debt. Use the Rule of 70 when you want that extra bit of precision, especially at lower rates. But most of all, use them to stay motivated and keep the incredible power of compounding front and center in your financial life. If you enjoyed this financial showdown, make sure to subscribe for more breakdowns that make you a smarter, more confident investor. Now I'm curious, which rule do you see yourself using more often? And what other financial showdown should we cover next? Let me know in the comments below. Thanks for watching.